Hello, Utar. Welcome back, everyone. So we're going to start with a 20-minute presentation, right to the 3:20 mark, okay? So, Utar, please, the floor is yours.
Yes, thank you very much, Douglas. So I will manage to deliver main idea in 20 minutes. Also, I will try to do maybe in 15 minutes to have room for one or two questions. So this is one of our publications, what we call business economics. So how to leverage on macro when making business decisions, and this is basically the framework is used for, of course, as I mentioned, for the group, financial group, but specifically in this case for our corporate clients. So basically, we have in focus residential real estate, but presentation also covers on a high level number of other sectors and number of other countries. So what is the main idea when deciding on optimal funding structure? So if you are business, so you have project, let's say in residential real estate or other sectors, and how you decide what leverage you should have and in which currency. Yes, in which currency. So in this context, there is choice between many currencies, but in our context, I would say it's broadly speaking local currency and euro and USD. Likewise in Armenia. Yes. So very brief introduction about from the perspective of central bank and from the perspective of the businesses. So I would say probably same holds true for Armenia, that all of businesses would say, or most of them would say, that residential real estate market is in USD, and central bankers would say, of course, it's in local currency. So we need local currency share to increase for many very good reasons. But according to our findings, and I will show you the charts, the reality probably somewhere in the middle. Yes, somewhere in the middle. And what I would like to emphasize here is that again, recall our previous discussion. So again, having, let's say, central bank projections and aligning your business plan to those macro projections would be a plan, but sort of strategy in this case, business strategy incorporating macro, would be to think of different scenarios. Yes, to think of different scenarios. And so as Roger Martin would argue, I'll share those slides. It's very nice, very interesting video attached to win in the competitive environment. Yes. So very briefly, I mean, those charts were game changer for the businesses. So as part of my role being chief economist, so I directly personally meet with our clients. And by the way, I have to say, not only with our clients, few were Bank of Georgia clients. That's also fine from our perspective. If something is important for the system and would improve efficiency of the decision making. So as you can see from those charts, so basically we have examples of Peru, Chile, Georgia, and Russia. And red lines are local currency year over year, but it's not USD dram, it's dram USD. So going up means appreciation, going down depreciation. And basically the dark lines year over year are residential real estate prices in USD. Yes. And of course, in Georgian case, also rental is added. By the way, I also have Armenian data. If we have time, we can discuss this also later. And as you can see, there is clear correlation, yes, between exchange rate and the residential real estate price for the in USD. Yes. So again, once again, very important that those charts were game changer for the businesses, because from those charts, businesses understood that it's not USD. Yes, and basically, or it's not maybe entirely USD. So and then they were of course willing to understand what are our suggestions. Yes. So
Dear Otar, sorry, can I ask a quick question about this? We clearly see the correlation, but is that because of just the real estate prices are in USD, so they are translated into USD, and because of this exchange rate fluctuations, we also see the correlation and fluctuations in real estate prices. Is that just because of this?
Yes. So of course it's not because of this only, and we also have some quantitative stuff to control for other variables. Yes, like GDP, mortgage growth, etc., etc. We have done this only for Georgia so far, but are in the process of doing same stuff for other countries. So basically, it's not only exchange rate, of course. Yes, it's not only exchange rates. Other drivers as well. But of course, exchange rate plays very important role. So quantitatively speaking, so just assuming when controlling for other variables. So from USD gel, I'm trying to save time because it depends. I mean time lags, also the magnitude of depreciation, because it's non-linear. Yes, if you have high depreciation, you have higher pass-through, etc., etc. But assume for simplicity that the pass-through from USD gel, technically speaking, gel USD is different. Yes, from USD gel, pass-through is something like 50%. Yes. Now, if the company wishes to be hedged, the answer is straightforward. Yes, they have to borrow 50 in USD and 50 in gel. Yes, if they wish to be in hedged. Yes, but also what should they take into account? Yes, many other drivers when making decisions. Yes, so for example, higher interest rates in local currency, that's important to consider. On the other hand, very important to consider the costs. So, because again, currency-induced credit risk is on income side, yes, in which currency you have debt and in which currency you have denominated income, underlying income, yes. But costs are very important also. It's not only interest rate, because interest rate is against argument for lower share of local currency, but take into account also commission fees, because number of high share of expenditures for the company is in local currency, yes. And once they borrow in FX, they convert at banks and have very large commission fees. Yes. So what I'm trying to say, everything this is in business language. So first, whether you are hedged or not, and second, then you have basically the cost structure. But again, in short, to illustrate the next step. So basically, if it's 50-50, so forget about cost structure for the moment. So if it's 50-50, 50% gel, 50% USD, yes. Basically, what if the FX part is Euro USD? So if FX part is Euro USD, I'm just illustrating as a direction. Then 50% gel, maybe 40% gel, yes, because on the FX part, risk of Euro USD is lower than the risk of Euro or USD only. Yes, basically that's true. And by the way, also for the reasons that if you have high depreciation combined against both currencies, you have higher probability of inflation, which also translates into higher basically real estate prices. Yes. So another question. So I'm not sure I can follow slides in 5 minutes, but I'll try to illustrate the most important. And another question is whether euro or USD risks are equal. So whether euro is same risk for Armenia and Georgia as compared with USD. Yes. So we have number of slides here, so if you look at correlation in 1 day, 1 week, it's more stable against USD, but the underlying currency is more euro rather than USD. Yes, we should have Armenia. Yes, for sure, somewhere here. Yes. So again, now next step is if you incorporate that argument, yes, in your analysis. So again, the goal is you have company which works on their strategy, and you are trying to incorporate macro in their basically decision making. Yes. Now you can go further. Whether from medium to long term perspective, euro or USD is undervalued or overvalued. Yes, or like Douglas asked excellent question on global risks. Yes, and in that context, by the way, I hope. I mean, I really. It's really terrible to see those developments in Ukraine. But again, conflict resolution, yes, for Armenia and Georgia, maybe stress scenario in terms of migrants outflow. Yes, I mean, we were discussing the overheating globally, but also one may argue that we have quite strong above trend growth rates for Armenia and Georgia in last couple of years. Yes, that may be also true. And if you have conflict resolution and possible lifting the sanctions basically on Russia, so that could be and should be, I would say, euro positive. However, our currencies may not follow this time because you might have migration outflow and currencies may be weakened. And for which sectors this should be particularly important? For the real estate sector, because I mean it's same. Yes, if you look at rentals in Yerevan, Tbilisi, those are elevated because of the migration impact. Not only, but because of migration impact. Yes. So overall, again, what is very important overall? So it's not about risks only. It's also, I would say, about opportunities to make smarter decisions. Because according to our estimates, even without depreciation, of the currency, in this case, residential real estate developers at least may be better off. Why? If you price your risks, again, real estate projects, Areg, as you mentioned, it's not about exchange rate only. Yes, for sure. Yes, but if exchange rate risk plays important role, if you have currency mismatch, if you hedge, you can have lower capital requirements, so higher leverage. Yes, so basically, if you do only USD borrowing, you should have higher capital. Yes, as a company. And if you do multi-currency as a company, you can have higher leverage. So basically, if you have higher leverage, your internal rate of return goes up because cost of capital is higher than cost of debt. Yes, just simply speaking. Yes. And by the way, this is not confidential. What I'm now describing is underwriting standards we are using. Basically, if you want to come at bank and borrow for this project in this sector entirely or in USD, that's possible, but you have to bring higher capital. Yes, but if you do multi-currency, you are able to have lower capital. And again, for last, I guess, 6 or 7 months, we don't have any new exposure in USD only. And by the way, we managed to change the currency composition of few existing exposures. Yes. So what was the game changer in this case? So basically, that chart was game changer for the businesses, but also other incentive structures. What is basically the capital like understanding costs, commission fees, etc., supporting national currency. But also, we are not there, but also we are waiting for regulatory approval. Basically, if it's multi-currency, the exposure to be treated as fully hedged. Because if it's unhedged, the bank is required to have additional capital requirements. Yes. If you do, let's say, 50% gel, it is treated as hedged in only partially. Yes. So according to the gel share. But if we agree again, if we agree that especially gel Euro USD structure is a hedged, yes, then basically you can create exposure as a hedged fully, and in this case you have also lower interest rate because bank has lower capital requirements. So if those two inputs are there, the company is better off even without depreciation. Of course, in case of depreciation, they are better off because the value of basically housing in dollar drops down and you have higher debt. Yes. Also, many other arguments like of course the invoicing currency phenomena. I think Gita Gopinath writes about this from IMF a lot. But in our region, in real estate market, there is also invoicing currency phenomena, yes, supporting some dollar share. So basically, that's very briefly. Also, maybe I will highlight. That if you ask in which currency, the at least Georgian real estate market is most stable, it's in real gel. So inflation-linked gel. Yes. So it's not in nominal gel, not in USD, not in euro. It's in real gel. But then when you play, if you do nominal currencies, then of course you play with basically with weights. Yes. So that's basically overall what I would advise bankers and basically regulators to implement. However, with this, also I will say very briefly, we have 2 minutes. Possible next step, which is basically trying to play with currency misalignments. Yes, especially if you are if you have long-term projects. So basically, that means if from medium to long-term perspective, you have arguments that euro is undervalued. That's an argument to borrow less in euro than otherwise would be reasonable. So in this regard, I mean, in terms of this component, we also did back testing. This is also in our publications, and basically, if corporates in Georgia would follow that strategy, I mean, that works well. Of course, as always, that doesn't mean it will work in the future, but still, for those of you more or less familiar, it's basically quite similar what people call DBS, so Development Bank of Singapore, their approach. Yes, but again, I would say, in my view, for regulators and banks, those first two steps are important, especially whether it is hedged or not, and also how you adjust the underwriting standards. Yes. So I guess we don't have more time. So thank you very much for listening. And we are presenting this stuff in many countries. And if there is interest, I'm happy, of course, to present in more details.
I found that really interesting. I was trying to figure out why not 1/3, 1/3, 1/3, but now I know why it's 35, 25, 45 or 40, sorry.
40.
Okay, good. Well, I think it would be really nice if we could actually arrange a longer time for you to get together with us and I think commercial banks possibly in other regions and so on, OTAR, because I think you have a lot to teach us, all the experience on working on financial stability issues at the National Bank of Georgia. In all my time that I spent interacting with people on financial stability issues, I don't think I've ever seen anybody go deeper than OTAR. Worried about
Thank you very much.
every possible thing under the sun. So we'd very much like to,
Thank you very much.
stay in contact and learn, as much as you've forgotten. Okay, if we could just learn that, I'm sure that we'd all be well ahead. We had a little bit of problems with the sound system, like I think both in terms of the input and the output. So there was a few times where I didn't follow precisely what you were saying. But let's start. Does anyone have any questions for OTAR?
I have a question.
Okay.
Dear OTAR, thank you very much for this presentation. And actually, I have one question, like deciding what is the optimal strategy from this point of view for deciding between currencies. I would also like to know what about the expectations, like can this model be more dynamic, incorporating expectations about the future, yield depreciation or appreciation, because in that case, maybe also the interest rates will play a role, because when people expect that the currency will appreciate or depreciate, so the interest rates in foreign currency also will behave somehow, depending on is that the appreciation or appreciation,
Yes.
and could this expectation also change the rules of the game in this case?
Yes. Yes, thank you very much. I mean, that's a great question. And of course, I mean, likewise, central banks. Yes. So when we meet with businesses, first they ask is projections and expectations. Yes, like what's gonna happen next month, etc., etc. Yes. So we do this basically. Of course, also we try a bit internationally, but what we disclose, and I think that matches nicely with the suggesting multi-scenario framework. The big question is, okay, I mean, first of all, I guess there was Douglas excellent work, I guess, from Ken Rogoff on random walk of short-term projections, yes, or maybe by others also. So again, first to start with Euro USD. So okay, if I tell, I don't want to name business, but real estate developer in Georgia, that's my projection for Euro USD. So they may believe, but of course they should ask questions that, okay, maybe it's priced in. Yes, maybe the arguments you talk about, whether it is conflict resolution or deeper crisis in Euro area or Trump trade, etc. Maybe it's priced in. Yes, I mean, if I'm able to predict Silicon Valley crisis before the market, yes, then somebody should believe my short-term projection. Yes. But frankly, I'm not in a position. Yes. So, and I explained this to the businesses that, again, we provide short-term projections, but that basically markets are very volatile, and one of the charts we illustrate here is again, let me show this very briefly to save time. So it's basically like so implied Fed fund rates. Yes, you see this on the screen, I'm sure. Yes, so basically, and how volatile it was. So you have Silicon Valley, hot inflation, etc., etc. So and basically, of course, then as you mentioned, it's more like 5-year, 10-year, 2-year correlation between, if you talk about Euro USD and the real yields. But of course, all this matter. Yes, and if you are in this environment, we advise to be more medium to long term oriented. Yes, you see what I mean, rather than relying on basically on short term projections. Yes.
So I'm just curious, Utar, if we could just kind of
Yes.
run through kind of how I would think about this. So I like an FPAS Mark II actually, it's very similar to what Ray Dalio has done as an investor for many, many years, like when he created his hedge fund on this. In fact, amusingly, even the dynamic learning environment shares similar characteristics and stuff. But the way he thinks about it, there's a quadrant, okay, or actually 4 quadrants, and in two of the quadrants. So we think about that for monetary policy. Things are a no-brainer because if you have excess demand in the goods market and inflation, interest rates are going to be higher, okay? And then you'd say, okay, well, what about if US got hit with the same shock as the euro area? What would that do to the exchange rate? Well, the idea is that the US might be weaker on excess demand, potentially weaker on inflation. So you'd have to think through that in terms of objectives. And we have models now, we call them mixed complementarity problems, that allow us to think through that problem much more coherently than back in the old days when we had interest rate reaction functions. Then, of course, you'd say, well, what if we get hit with a big negative one of those? So we get a negative output gap and inflation's lower. And of course, that's another no-brainer for the monetary policymaker because he wants to cut interest rates. And that is really only complicated when you're at the effective lower bound. And then you run into a big problem, right? Like what happened during COVID when the euro appreciated by 20% because the Fed was employing highly expansionary monetary and fiscal policies, driving real interest rates lower and so on. So exchange rate movements of 10% with respect to the euro US, we could tell a story about those two quadrants. From an investment point of view, and Bill White was emphasizing this last night, there's the Goldilocks positive supply shocks of the great moderation. And of course, everybody's happy. Equity prices are high. Then there's an area where everybody loses, except people holding gold and real things like so that's the stagflationary shock kind of scenario and so on. So what I was curious about is that when you think about your balance sheet, okay, what I worry about is the one in that scary world where there would be a crisis of confidence at some point. And I'm not talking about this year, could be next year, could be the year after that, possibly could be the year after that, the year after that. But in my mind, the probability at some point over the next 5 years of something really bad happening based on some very simple non-linearities. And that is if the interest rate rises to that critical threshold as it did during the European debt crisis. So for example, when the 10-year bond rate, gets up to 6%, things are, well, they had a European debt crisis. So 7% was the month when it actually peaked and stuff. But one can imagine with the debt in the United States, the 10-year bond rate now is 4.5. The term premium associated with that is only 50 basis points. If that term premium returned back to pre-GFC types of levels where there was concern about inflation and so on. So say it rose 150 basis points, well, that would take us up to a 6% 10-year bond rate. And that at that rate, people might start to question, is it sustainable? So one can imagine a situation where the Fed's cutting rates, monetizing, trying to keep interest rates down when the economy's crashing, equity prices are. So do you have that scenario factored into the way you think about the risks on balance sheets in banks?
Yes,
you have the-
yes, please. Yes. Basically, if we are talking about that scenario, yes, we have that scenario coupled with exchange rate depreciation. Yes, so USD becoming even stronger globally, and euro and regional currencies especially going down. Yes, and of course we monitor possible impact on growth. Of course, balance sheet, the currency mismatch, because when we do stress testing, so it's not only I would call historical relationship based and macro, call it macro style stress test, but it's rather what people call in US transaction level stress testing. So transaction level stress testing, as you know, means you have macro scenario, but then you have micro tools. So basically, when you have macro scenario, higher rates, higher depreciation, and higher and lower growth. So how that translates into micro tools when you're talking about, let's say, company, yes? So basically, lower growth means lower sales. And of course, especially for the cyclical sectors like real estate. Depreciation means higher debt. If they are in multi-currencies, that's different. But if they are in USD only, of course, that's basically different. And higher interest rates, depending on their, loan, whether it is fixed or floating, etc., etc. So basically, it also translates into higher interest costs. And after that, all this information is aggregated on a bank level. Yes, on a bank level. For large corporates, I guess it's more than 2% of capital. I guess if I'm not mistaken, more than 2% of capital is done individually. And then for SMEs retail, you do sampling and the all quantitative stuff you are able to do. And of course, separately you do the interest rate risk position for, as I mentioned, for bank. Basically, you could have U.S. Securities, deposits, etc., etc. One tricky thing there is that one has to differentiate between so-called onshore and offshore USD and euro, because in our countries, basically, there were cases when onshore, so call it onshore domestic deposit rates in USD were going down, while the LIBOR and now SOFR was going up. You see what I mean? Yes. So there is not even sometimes there is no. It's not the case that sometimes there is not no even perfect correlation, but those two move in opposite directions. Yes, and that's not only in Georgia. That's basically in many countries. Yes. So. Yes, basically that's one of the scenarios we have under ICAP and also recovery exercises. So basically, in ICAP it's lighter, and in recovery and resolutions and frameworks it's more basically more severe. And as a result, of course, then you have what I call macro risk appetite. So when you have the results, and of course at the later stage, supervisory board is also involved. Whether in this scenario they are happy with the results, because I mean you have to have problems in some scenario. Yes, you can't be protected in any scenario, but Now, then it's up to risk appetite, basically, whether you wish to increase your systemic risk or make it or maybe or maybe make it even higher. Yes, that's also possible because again, this exercise is about opportunities and risks, not risks only. And also, what is very important is looking at impacts as much as possible across business lines. Yes, across business lines, because you may have higher impact somewhere but lower impact elsewhere. Yes, and also looking at concentration limits. Yes, so for example, under this scenario, again, I'm saying very practical and real example. So under this this particular scenario, I can say we called it Fed tightening or dollar strengthening scenario. So also including commodities going down and other stuff. So basically, we also look at as much as possible for sector concentration limits and cyclical concentration limits. Yes, cyclical sector. So for example, if we are talking about residential real estate, this approach is also important from the sector concentration limit perspective because people differentiate quantitative concentration limit and qualitative concentration limit. From quantitative point of view, you may have, let's say, I'm just saying example. You may have, let's say, 5% of portfolio can be residential real estate, yes, but in USD. But if you have, let's say, gel Euro USD, yes, or half gel, half USD, yes. If assuming that's the right approach for to be hedged, yes, then you may have higher limits, yes, or you will have if you have let's say tighter underwriting standards, then you may have higher limits. So I mean, ideally, if you do your homework well, that should show up in stress testing results. Yes. So if you do your homework well, all this should show up in your stress testing results, and then deciding on your basically risk on your risk appetite. Yes. So in stress tests, again, our main scenario is. I mean, we also do, as I mentioned, we also do stronger euro like conflict resolution, lifting sanctions, and especially specifically for the real estate, it's very severe. Of course, similar holds true for Armenia, but our main stress test scenario still is dollar strength. I mean, it can be due to many reasons. Yes. So basically, that's the case. Yes.
If possible, boy, it would be nice to get your presentation. So if it's possible, you could send it.
Of course.
If I want to move things along here, but if anybody has any questions for Otar, maybe we could just save them. I just wanted to call on Narek, who I think is going to speak about his perspective. I think on these issues, perhaps on even other issues that were raised in the symposium and so on. And then we can come, if there's some more questions for you, Otar, and maybe you want to reflect on what Narek says, based on your extensive experience and so on. Hopefully he'll talk about financial stability and macroprudential. That's what I'm suggesting here.
Thank you, Doug. Thank you all. Thank you, Otar, for the interesting presentation. First, let me share my views as a board member on FPAS Mark II, and then I'll try to connect to things also to what Otar presents and what was discussed here earlier, and also the points that are raised. So a few key highlights about FPAS Mark II. We do believe that it's a more efficient framework for the achievement of a price stability. Now, for this goal,
the board of a central bank is setting the short-term interest rates based on the staff's recommendations, of course, and the economic and financial analysis that the staff is providing for us. We do stand ready to adjust the interest rate and achieve our ultimate goal, which is the price stability. Now, in between the short-term interest rates and the price stability is the monetary policy transmission mechanism. And this is one of key components. Now, what makes FPAS Mark II different? Among other things, we discussed a lot this avoidance from the dark corners. Dark corners happen when inflation ratchets up or down, and through the expectation effects, we may find ourselves in a bad equilibrium in terms of price stability. Earlier today, Otar was also highlighting problems of pro-cyclical monetary policy. Yeah. So monetary policy in a classic world should be acyclical, so restrictive when we have inflationary pressures, especially coming from the demand side, and vice versa. However, if a central bank and the board of a central bank is constrained in its movement and it is slow to adjust the short-term interest rate, inflation expectations may go up fast, and the real interest rate may fall down, and we will become in a situation when monetary policy is loose, when we have inflationary pressures. This Doug also touched this issue, remembering the COVID inflation shock, when major central banks in advanced economies were too slow to raise their rates, and inflation and expectations went up, and the policy became loose. And this is one situation where we can end up in a dark corner. Now, we do believe that having a baseline scenario and committing and communicating one certain most probable path can be one of the reasons which may constrain the board in acting fast, in being fast and flexible in adjusting the interest rates. So not committing to a certain trajectory, let's say call it a baseline forecast, which we had in FPAS Mark II, is one reason which can ultimately result in a higher likelihood of ending up in a dark corner. So one of the key virtues of Mark II is that the board stands ready to adjust the interest rates as much as necessary without any constraint, including a pre-commitment to a baseline scenario or having communicated to market an interest rate path. So this was very briefly about FPAS Mark II. And to sum up, to finalize my views on this, it is very important that the interest rates is being adjusted endogenously to the constantly changing economic and market environment. So we are in a world where we are looking forward, we're full of uncertainty, and when situation is constantly changing in internal economy, the outside world, in all the sectors, and we have this constant flow of new information. And having a case A scenario, case B scenario, and case X and Y scenarios helps really to manage this and react very effectively, proactively, and avoid finding ourselves in a situation. So these were the key points that I wanted to highlight about FPAS Mark II. Now, mapping all this to our collaboration with the private sector and financial institutions and commercial banks, I want to highlight the importance of expectation management. This is one of the key things, and this is a key component also entering the monetary policy transmission mechanism. Expectations are one of the key variables which make change in the transmission mechanism of monetary policy. On a very technical language, we have expectations appearing in many macroeconomic equations, in the Phillips curve, in the IS curve. On a non-technical language, expectations change the behavior of economic agents. Their views about the future have very strong impact on their actions, on their decisions to spend, save, and consume, and make contracts, what interest rates to negotiate. And in this area, inflation expectations, interest rates expectations, exchange rate expectations are critical. And they are managed through communication, interest rate actions, interest rate movements by the central bank, and the communication. Communication is key, which helps, so if done effectively, it adds to the credibility of the central bank, and more credible central banks achieve their goals with more efficiency. Now, when communicating under the FPAS Mark II, the Central Bank of Armenia defined key audiences, key target audiences for communication. These include general public, media, academia, and financial institutions as well, which play a very important role. So for each audience, we use different tools to communicate effectively. For example, for general public, the governor is giving the press conferences. We have a monetary policy report, which is being released quarterly. But today I want to highlight especially our communication with financial institutions, commercial banks in particular, fund managers, foreign, local, insurance companies as well. For this particular target group, I want to highlight one communication tool that we are using, and this is again developed under FPAS Mark II. This is special, this makes FPAS Mark II different from FPAS Mark I, and this tool is called the technical briefing, the technical meeting, which we do have 8 times per year. And during this meeting, the head of monetary policy or a chief economist and one of the non-executive board members are ready to discuss with financial institutions the economic and financial developments on a very, very detailed and technical level and language. So this is a very useful tool, in my opinion, to have this discussion. Above all, for all these things, communication, expectation managed to happen, and to happen effectively. Another very important thing is very critical, and this is in our objectives. So we want to have this common thinking with the financial institutions, with the analysts of financial institutions. And for this, we are ready to share our knowledge, our views, how we on analyzing issues, how do we see things, how we analyze. We open up our all the toolkit that we are using, including the models, the data, and this meeting that I mentioned. This also has the goal to have very technical discussion with financial sector experts. And again, the most important goal here is to have this common language and common understanding to achieve a level where we think in the same way when we interpret, when we do economic analysis and interpret developments in the financial sectors. This is very important because at the end of the day, this helps to really communicate and transparently convey all this information that we do produce in the central bank, and ultimately the interest rate movement, the decisions and the change of interest rates are really understood by the financial institutions. So if this is in there, if analysts within the commercial banks understand this very well, understand the monetary policy transmission mechanism very well, we will be able to adjust their thinking based on the data releases by their own. So we do have this case A scenario, which is about inflationary situation, and we do have a case B scenario, which is a less inflationary situation. And once this is well understood by the commercial banks, and when the data is released, they will be able to adjust their own scenarios, and they will be able to react fast and effective and predict the next move by the central bank. And this is not only about interest rates and inflation only. So now turning back to the internal analysis that the banks are doing. As Otar mentioned, banks are actively using stress testing, ICAP, which is about the assessment of capital adequacy internally, IRBB, which is about the interest rate risk in the bank balance sheet. And for all these actions, also estimating probability defaults, and so for all these actions, banks need basically scenario analysis, especially on the stress testing front. They do need all these scenarios. And FPAS Mark II is definitely more about scenarios compared to FPAS Mark I. And if we do communicate all these scenarios, sometimes these scenarios can be directly used in the bank, within the bank, especially the X and Y type scenarios where we have where we assume adverse movement and materialization of tail risks in the system, which will generate these extremely wild scenarios. We call it X and Y scenarios. This can be used. But overall, my point is that communicating lots of scenarios, sharing your machine, your production machine, sharing your knowledge about the transmission mechanism, and being fully transparent and training the economists in the commercial bank, sharing your knowledge helps really to improve risk management of the banks. And this is the key point that I want to highlight with the under the stress testing, IRBB, ICAP, and this, of course, will impact also financial stability at the end of the day. And this is all I wanted to highlight on Mark II and its applications, and how it can also improve risk management among the banks. And just one final comment on the work that Otar presented. I think it will be when you discuss the forward-looking applications, how to look ahead. Otar mentioned about random walk behavior of the exchange rate, and when Doug nicely told the stories, how we can see the future exchange rate appreciating or depreciating depending on the macroeconomic developments. So I want to highlight that FPAS Mark II with its scenarios is clearly conveying also messages about the direction of the exchange rate. In the Central Bank of Armenia, actually, we do publish the exchange rate trajectories as well under the case A and case B scenarios. And these can be directly used in risk analysis like the one that Otar presented, and when you will have a response of how to structure your balance sheet and improve the risk management. So this was all on my side. Thank you for your attention.
Thank you, Nark. And I can tell from looking at the audience that there's a little bit of dissatisfaction out there. I can see it because they're waiting for the real juicy part, which is the way that you guys are talking about it. It sounds like it's all done. there are no more challenges. That FPAS Mark II has solved all the problems that, and so they obviously want work to. That's why they're staying here on this Friday afternoon. Now I can see the happiness. So let's turn it over to challenges, okay? And the reason I want to bring this one up is I suspect Otar and Hike, as well as Hike K over here, maybe you have views about this as well. But in the early technical assistance that I did with the Czech National Bank, which started when they were about the same income level as you are today, and they had this thing called a FRA. Maybe you guys are too young to know what a FRA is, but it's a forward rate agreement that allowed them to construct the expected path of the policy rate. When we went back to do research to ask the question, when there was a publication of a monetary policy report that published the expected path of the policy rate, so we could observe that expected path the day before the release of the monetary policy report and their projected path of the policy rate. So that very simple thing, like having a FRA, helped us to, I think, interpret whether or not the framework was doing its job, that financial markets were adjusting appropriately in response to the information in the monetary policy report. And today, I think we've kind of probably gone beyond FRAs to options markets. So tell me a little bit in Georgia and Armenia, like how much would you benefit from developing a market like that for communications, for understanding monetary policy, and of course, for using it possibly to ensure, allowing commercial banks and other financial institutions some instrument to be able to ensure risk. So I don't know who wants to take it, Otar, and as well, if you have any other additional challenges like communications, for example. I never really touched on that very much, but whoever feels like they want to take the first stab at this, please.
Yeah, thanks, Doug. I think you really touched to the point. So I think it's currently, as a staff member, like from my point of view, is the biggest challenge for this framework, because as I mentioned, we are really putting lots of emphasis on market expectations. So the entire framework is centered around the market views and the board views. But the reality is that actually we don't have quite a developed financial market yet. So the staff is really putting lots of effort in order to understand what is currently priced in the markets. Currently, we have two options for that. One is related to the surveys that we're conducting among the financial market participants. And the second option is to look at the yield curve. And I think both of them are not perfect, obviously. The survey has their own issues, as usually they are not taken seriously. So the answer from surveys sometimes are not up to the quality that we want. And also the yield curve is also distorted in Armenia. Because of the small market, because of small actual deals in the market, some optimization techniques that are used to construct the yield curve because of this few deals, and also the actual behavior of Ministry of Finance in terms of supplying the bonds and cutting in some cases the interest rates. Basically, in some cases, they are not reflecting the market price. So considering these two options, actually it's quite challenging to extract the market expectations from both of these two measures. And I think the further development of the financial market in Armenia, like as you mentioned, the inclusion of other instruments, let's say the inflation index bonds or other type of instruments, I think it could really enrich the discussions regarding what is market currently is pricing, and it will very much benefit the implementation of the framework and will help more informed decisions at the Central Bank of Armenia.
Otur, I'm surprised when you were deputy governor of the National Bank of Georgia that you didn't do something like this, but you must have thought about it, no?
Yes, well, frankly, I was more working on FX hedging to basically to I'm not sure whether it was correct or not. You have many other arguments, but I mean, besides what's case for Armenia, I mean, as you suggested, Douglas, to maybe to talk about a bit maybe relate on the related area. So. I mean, I think it's broadly same in Georgia, broadly same, I would say. But on FX side, so basically, you mentioned expectations, and whenever we have a shock, we have always excess FX liquidity in the banking system. Yes, so now I mean this is. Our estimates, some political tensions, election related in Georgia. So, according to our estimates, there were conversions like from jail to FX, and also on the credit side, less FX credit and more jail credit, or equivalent of how we estimated more than 1 billion USD. 1 billion USD. Yes. So basically. And basically that was same. COVID was severe shock for everyone, but also for all countries, but specifically for countries relying on tourism. And also during COVID, we had just all-time high liquidity in foreign currency. I mean, in the banking system. Yes, and same is today. Yes, same is today. So. You have whenever you have shock expectations related to COVID or dollar strengthening, etc., etc. So shock is amplified. Shock is amplified by this basically pro-cyclical behavior. I mean, one can argue you should allow exchange to overshoot, but then you have the inflation problems and even more. Maybe even more depreciation, and then you have to maybe hike more aggressively to be even more pro-cyclical. Yes, so thanks for asking, but basically that's what I was working on. Again, it's very complicated issue. I would say unconventional, but in my view, that's a complex topic. Sorry if I'm moving somewhere else, but it's complex topic. But in my view, if there are some hedging instruments, commercial banks to be able to transform during shocks those excess FX liquidity into the local currency. Yes, that would even avoid the procyclicality of monetary policy the way I understand it. Yes, in our region, because at the end of the day, I mean, I think that's again, like you mentioned, problem. This is very important. Financial markets, I fully agree. Maybe at the end of the day, this is the most important problem when you have external shock. Central banks, government banks, they have estimates. What is FX shortage, what kind of adjustment you need. For that, maybe what sort of what level of external borrowings, etc., etc. But at the same time, you have so again, country is facing call it simply speaking FX shortage, but at the same time, you always have just access all-time high liquidity, FX liquidity in the banking system. Yes, so I think that's also very important problem, which is very difficult to overcome. I would say using call it conventional instruments. So probably there you need something unconventional and like colleague mentioned, also inflation-linked products. I think it's very important. In my view, again, of course, you have more seasoned people in this area who has done more analysis. But in my view, the fact that we have not even tried, inflation-linked products in our region. In my view, that's basically a mistake. Yeah.
Okay, so I just wanted to end it on one final question that's related to that. But Narek, you might choose to come in and talk about what Heike was talking about. But I'm asked this question all the time. We were asked this question last year. What about the communication issues? And I know you guys have touched on them at all, but a bit during the symposium. But I really want to ask this question because everybody's always asking me this question. Doesn't FPAS Mark II pose these massive communication problems because you've de-emphasized the baseline and so on? So the question is, from your experience over the last year, how difficult do you think that issue is? And it's nice to have Arik here because Arik's from a commercial bank. He's from the other side of it, but he's a little bit special because he used to work at the central bank, so he's not, he does have that disadvantage in the sense that, he knows about what central banks do and so on. But please, can you just all three of you and Heike as well, sorry, all four of you, just how would you answer that question? Because I'm getting that question over and over and over again, and I want to put something on the public record that I can actually write up afterwards, okay? Not to put any pressure on you, but please. Narek, do you want to go first, maybe?
So obviously, we went out of our comfort zones when under FPAS Mark II, we decided to utilize a wide range of risk communication tools, and we decided to increase like exponentially the transparency of what we are doing, starting from publishing the data, the models. We added maybe 5-6 pieces of new communication vehicles, including minutes on the board discussion with individual board members. Registers are there with their views, with their names published. So basically, it's similar to publishing a recording of the board meeting. Okay. Then we also publish the individual board member backup and his or her view why he or she voted in a way that she did. Okay, so individual board members story and the backup of voting in a particular way. This is also new. So overall, we added immensely on the transparency. And again, this is pushing ourselves out of a comfort zone. This is extremely challenging, but in the meantime, this is extremely promising because, like I said, transparency is key for expectation management, increasing credibility for effective communication. Because if in particular the experts and the analysts in the financial institutions, in the banks and other financial institutions, if they don't fully understand what you are doing, the only choice is the only chance that they're gonna trust you is just that your historical credibility, and this is a very shaky approach to communicate in a way that we have this historical credibility, we are the most powerful, we have a good economist, and that's it. No, we went out of that logic, and we opened up. We provide all the information, of course, in a structured way. Now, this is creating lots of work, lots of challenges, and we are now managing way more information, processing way more information than before. And if this information is to be published, definitely it's going through double and triple checks, and adds pressure on the central bank. But again, the fruits are very promising. We are ready to go there. We made the decision, and initial signals coming from the market, Doug, I think are very promising, and we will listen to our colleagues from the commercial banks present here. So in short, we moved ourselves from this comfort zone, but we have objective. And touching the first point on the challenges, another challenge is the derivation and of market expectations, with market views on the interest rate, because this is a critical input when we start the decision-making process. We construct our case A and case B scenarios relative to a market reference rate. Now, given that the derivative instruments are not that actively used in our market, it's very difficult to derive the reference rate. So we rely on the yield curve, but the government bond market is more or less the best, the deepest, one of the deepest market niches in the Armenian financial system. We derive it from there. There is a room for improvement, but still, it's very useful and trustworthy what we derive. We add more judgment, but this is one of the challenging areas that Doug was asking for. I want to highlight the issues that on the market reference rate we have to work more, and this also we have to work more on our side by adding judgment and discussions. So we discuss a lot when we pin down the market interest rates. So of course, first we derive it from a yield curve, and we use other models, and then we add judgment. And over time, if financial system starts to use more actively the derivative instruments, forward swaps, future contracts, we will have a wider option of deriving market expectations from these instruments, market expectations of interest rates, and we can achieve this goal of making the market to use more actively these derivative instruments through our supervisory tools. We do discuss with banks their risk appetite under the ICAP, as I already mentioned. So this is a supervisory requirement. IRBB is also a supervisory requirement, and the derivative instruments should be, among other instruments, the derivative instruments should be used to manage the risks in the bank balance sheets. So once these instruments are being used more widely, we will be able, I think, to pin down the market expectations on interest rates more effectively. And that's my vision about the solution of this challenge. Thank you.
Okay.
So this is really a topic I wanted to touch and talk about. But before talking about challenges, disadvantages, really a challenge, I want to start with some advantage of Mark II. Now, under Mark II, central bank provides us more deep research and more tools to understand monetary policy. And Narek touched a very important topic earlier. Monetary policy is, of course, about inflation expectations, and sometimes it is difficult to understand whether these expectations went up faster than the monetary policy reacted. So are we in a situation that monetary policy is loose while expectations are high? So before, under Mark I, we couldn't see any quantitative estimations about this topic. But now under Mark II, let me share my screen. And let's go to this monetary policy report chart pack. And here we see that now central bank also provides estimations for the neutral policy rate and its uncertainty around it, but also the contribution to these neutral interest rate estimates. And you can see that mostly the main proportion of it comes from inflation expectations. So, I'm not talking about just my perspective, but I'm talking about commercial banks' perspective. And we are not blindly believing what central banks board members saying, but we really need these estimations. We really need some quantifying stuff to understand what is going, to understand it deeper. And with this information, you can really see where is the neutral rate, where is the central bank working now. Can we really call this situation like this episode tightening of the monetary policy, because it always should be compared with the neutral rate, because just that central bank, for example, decided to cut the interest rate, it doesn't mean that it is going to have some loose policy or otherwise versa, a hawkish policy. We should see this neutral rate, and now we have this tool. But now I want to talk about the disadvantage, the challenges of providing these tools. I'm not quite sure that the capability that commercial banks as a whole have now in their research side, the institutional capability of doing research, understanding better what is going on, is sufficient enough to understand and to translate this information and to use it efficiently. Of course, there are some banks that can handle it, but I'm again talking about the whole commercial banks thing. And from the other side, like before under Mark I, when banks had that best kind of scenario, most likely scenario, baseline scenario, and they where the background of their decisions were mostly this scenario. Now you don't provide this scenario, and banks should develop their own research capabilities, potential to make forecasts to to have these baseline scenarios. Of course, they also should consider this risk management approach, but they should do it for their own. I'm not sure that the gap between the central bank's capability and commercial banks' capability is narrowing right now. So this is a challenge, but I'm not saying that it is impossible to overcome this challenge. Of course, it is possible, but I would like to you as policymakers to take this into consideration and in a collaboration with commercial banks, understand how can we further develop commercial banks' potential capabilities to narrow this gap and to talk with the same language. Also, one advantage is from this point of view is that, as Narek also mentioned, we now have technical meetings. So financial market participants and central banks, policymakers and staff, monetary staff, meet and discuss these kind of questions. And I think this is a step forward, but I'm not sure that this is enough. So this was the main challenge for me from this perspective.
Can I react a bit? So I just wanted to say that the fact that you are sitting here and talking at the same language as we, it's an indication of the narrowing gap.
But sorry, as Doug mentioned, I may be kind of skewed because of I maybe know a little more about monetary policy that commercial banks specialists in general know. That's why I said that I'm trying to talk from the whole commercial banking part, not just from my perspective.
Yeah, I got your point. Thanks for providing it. And I think you mentioned, Narek also mentioned the meeting with analysts is one of the steps, but we are also conducting regular workshops with commercial banks. So we have done it previous year, and we are going to repeat it. I think it will be in February or March, the next one, and we will continue this series of practical workshops, like and seminars with commercial banks and financial market participants. I think up to the point that we understand that this gap is significantly narrowing in terms of their understanding of the new framework, in terms of their understanding of this current analysis and everything that we're publishing in our external communication documents.
I should only say that thanks for that. Kush out there is actually helping us to solve your problem in the sense that we're creating these clubs. So think of it as the central bank club. So we have the Global Forecasting School that we train people at the Central Bank of Armenia and the National Bank of Georgia. They're obviously big economies of scale there, right? Because you're little countries with 3 million people, and you're doing things that that countries that have $50 million budgets can't do.
Yeah.
Okay, so I think there should be a little bit of lesson. The AI, the way that we see it, can really help to improve the training process. In other words, it sort of reduces the critical threshold of how passionate or crazy you have to be able to dig deep and program. These are the, sorry to pick you out, HiCast, the guys like HiCast and people like that where they invest enormous amounts of time and energy. It's not an 8-hour day for these guys. They go very intensively sometimes throughout the night working on things that nobody else would do. Okay, well, the nice thing about this is that ChatGPT and artificial intelligence can now write that code, and as long as you learn how to use that, as long as you become a better prompt engineer, and we think that we can develop technology that's even better than we have now if we specialize some for central banks and some for commercial banks, but it's focused on learning. For example, in the Global Forecasting School, to get up to level 1, we don't let them touch any models, because we know that if they get into models, they probably might not learn economics. So we want to see evidence that they can learn economics before they start playing on the computer. As soon as they get to level 2, we want them to be expert modelers because they know some. So just in terms of preparations here, so we're offering to work with commercial banks like you and all the other people in Armenia and Georgia, build training for commercial banks, okay? In information areas where they feel they can share, like training. That should be a clearer place where they could do so. Now, we also, unfortunately, Simon is not here. He was going to talk at 4:30, but we have Asya. And some of the stuff that we were demoing, that Annie was demoing with ChatGPT, showing that ChatGPT 4 now, the Teams version, can run Python code, not just write the Python code, but run it. Well, we will be able to, you guys will be able to effectively talk to your computers and generate scenarios, manipulate the models, learn how to build the models yourself. Okay, now why do I say, why would you want to learn how to build the models yourself? Because my experience has been, is that if anybody takes anybody else's model, they never really understand. They never really understand it. They never really understand how to use that model of someone else's until they built models themselves. Once they built a whole bunch of models themselves, then when they look at somebody else's model, it becomes a very